So y'all remember next week, 3 buttons. That's
good.
Or Alt R.
All right. So I would encourage you guys to check out that Earn Your Leisure podcast. Like I said, it happens every Monday, but they just have just good conversation about finance and stuff like that in general. So I would definitely check them out. So I actually wanted to start off by again welcome Kendall, welcome Winston, welcome Dante. So as a welcome note, I'm gonna have a couple brothers just take one thing that you've learned over the last couple of weeks that you want to share with them, because I'm gonna have Brian Show walk us through in a minute. But share one thing that you learned to kind of like give them a cliff notes, catch them up to speed kind of thing. So think about that. And while you're thinking about that, let me ask you the question. So Kendall, you're gonna go first.
Okay.
Why are you here?
Well, BG told me about it. The first time that you offered this class, I was supposed to be in it. So just the week got away from me, and I just lost track of time. But BG and I have been talking about stocks over the past week. So the passion is there. I just need more knowledge. So that's why I'm here.
And if you were to rate yourself on a scale of 1 to 10, 1 being like, I don't know what the hell I'm doing, and 10 being like, man, I got millions in the bank, like, where are you at?
I know enough to know what a share is, but that's about it, So I have a couple of investments now, but all I do is log on to the app, see if it went up or down, and I don't know much about anything else. So,
yeah.
So
you're in good company.
Yeah.
Perfect.
Yeah.
So just so you know, we have a little bit of a range of experience and a range of like how people invest and engage. So you're in a safe spot. Feel free to ask questions and all of that.
No doubt. Appreciate it.
All right, Wentz, what about you?
Off mute, man.
You're on mute, bro. Still on mute.
You're on mute. Unmute yourself.
Okay, are we good?
Yeah, you're good.
All right, I came to hear Nate's playlist. No, for real. I think what has bothered me is being able to, and nobody can really do this. It's really a lot of educated guesses, but trying to figure out, where the next hot tip is, where the next, next hot stock is. And then at that point you can go from there. But I mean, that's just the surface. Obviously I don't know, I know about shares, I know about trading, I know about options and things like that, but it's very surface level type of stuff. So.
All right, Dante.
Well, essentially, I don't feel like I know anything about trading. I mean, I know what a share is, and I know that essentially you want to try to get it as low as you can and search out things that you can expect growth. But other than that, I don't know much about it.
Okay, good. Well, we're glad you're here then. That's perfect. Glad you're here. What you say brother's name was Mike? He said his name was Mike Goddard?
Yeah.
All right, Mike. What you got? What you interested in? Where you at?
I'm interested in a lot of stuff. Right now I'm doing like the foreign exchange market where I trade currency pairs like the USD, JPY, and stuff like that. That's what I've been focusing on lately. But I read like the Motley Fools and stuff like that in the past just to read what's like the trends and stuff like that.
So where would you say you are on a scale of 1 to 10?
I'll probably say I'm at a 2.
All right.
Because there's always more to learn.
That's good. Yeah. So full transparency for you guys that are new to the room. In no way, shape, or form are we gonna we're gonna leave you behind. But I will just tell you, like, you might walk out of this week feeling like confused. and not really fully understanding. But that's totally all right, because we're gonna just keep on coming, come every week, and eventually I can tell you that brothers that are here right now, some of them were in the exact same spaces that you were 2 weeks ago, and now we got brothers open up Robinhood accounts. You know what I'm saying? So it don't take long, and I think the conversations that we have are really fruitful and allow for people to be able to catch up, relatively quickly, right? So and don't be afraid to ask any questions, because we're all going to learn here together. So what I wanted to share with you is actually connected to something that Winston said, and actually connected a little bit to something I heard last week. And James, I haven't forgot about you because I want to know that question. But in order to be able to answer it, they got to understand what the question was in the first place, right? So investing, I think a lot of times, as a people, we think about like, what's the come up, right? What's going to be the next hot stock, right? And the truth of the matter, when we're talking about investing, you got to think of investing as a long-term situation, right? We're not talking about day trading. We're not talking about like, some flips. We're not doing house flips, right? We're talking about, I'm looking at a company that I think is going to be viable for not only tomorrow, but for several years in the future, so that I can make some money off of them. And essentially, we got a couple different ways to be able to do that. One, we can look at kind of growth stocks, right? And the growth stock example would be, say, something like Google, right? A lot of the tech companies would be considered as growth stocks, where you're making your money off of the improvement of the stock price, right? So that stock price is $30 today. 2 years from now, it's 70. You made $40 per share, right? But that's not the only way to make money in the market, right? Another way to make money in the market is around dividends, which is what we talked a lot about last week, right? And there are people who just do dividend plays that just get paid off of dividends. So you have an example like Coca-Cola. Coca-Cola is currently trading at like $40-something, probably like $41, $42 right now. And I think if you go back a year, it's probably still trading at $40-something. You go back another year, it's still trading at something like $40-something. So you ask yourself, like, wait a minute, how do I make any money off this thing if the price never goes up? And the answer to that is that folks are making their money off of the dividends, right? So we'll talk a little bit about that. But I wanted to share with you guys, I'm going to share my screen real quick. I wanted to share with you guys a popular concept that folks get caught up with when they talk about, like, I don't have any money to invest, right? I don't have any extra residual income and stuff like that. So every week I share my own personal account, and Cogs actually brought this to my attention last time we spoke. So I just want to like not intimidate people and bring them up to speed. Let me open up my account here. So I use Charles Schwab. That's a brokerage account, but you use whatever brokerage account that you're comfortable with. So I've never really gone through this whole thing, so I just wanted to share what it looks like and why it's here. So my personal value is $87,837. So if somebody sees that, they're probably like, man, shit, I ain't got that money. I can't do that, so I can't invest, right? So I want you to know that was over time, right? That didn't happen like overnight, right? And so then today, today, the market went down a little bit today after going crazy the last couple of days. So this is kind of the change that happened today. So overall, in my entire situation, my stuff went down by $69.62, right? I don't care about that because I'm not selling anything anytime soon. But here's what I want to bring your attention to. A couple things. So I have a couple different accounts, and I want to share those accounts with you in case you're interested. So one, this is my individual account. This is the account that we talk about all the time. I'll show you that in a second. And then this one is my Roth IRA. which is separate from my individual account. This one, I can't touch the money until I'm 69 and a half without penalty, right? So this just kind of sits as it were. And the individual account is kind of like what I pay attention to and feed into more often than not. But before I really talk about those, I want to talk about these three. So these three accounts are my kids' accounts. So that's my son's account, my daughter's account, and my other son's account. So my daughter here is 8 years old, by the way, right? And I sat down and had a conversation with her to say, like, hey, what stock do you want to invest in? And so these stocks that you see here, these three stocks that you see here are stocks that she chose, okay? These are stocks that she chose. I give them $100 a month. What I buy, so you'll see 2 VOOs. Essentially, that means for the last 2 months, I bought them VOO, which is a ETF that mirrors the S&P 500. So I buy this on the regular. No matter what, that's what I buy for them. They buy these. Now, when we sat down, I want to buy Etsy. So the first thing we did, I was like, all right, let's go look at the stock and see if it's a viable company. And the stuff that we've been talking about in this meeting, she used that same information, except at the 8-year-old level, and determined if she wanted to buy it or not. Now, I say that to say, my 8-year-old daughter, 8, chose a stock that has gained 17.53%. And another one that's gained 15.6%. And another one that's gained 13.48%. So you can do it too. So that's number one. Number two is she has 1 share. This cost her $80. This one cost her 104. And this one cost, oh, excuse me, that's not true. This cost her $68. This cost her $90, and this cost her $103. You can afford stock. There's stock that are cheaper than these. If you wanted to buy AT&T, it's going to cost you $31. You're spending $31 at McDonald's tonight. And you could buy 1 share. You don't have to get in and have, you ain't got to come in and have a $87,000 portfolio. You don't have to have this. That's not necessary, right? What is necessary is for you to start. So I think what was really exciting about what I saw with Brad is that he was like, hey, man, I'm starting. So I want to encourage you all that haven't started yet to get started because you don't need a lot of money to do it, right? Which, yeah. Just ask Google. Ask in the living room.
Ask Google.
So, and then again, just to kind of drive home the point, this is my son's account who's 9 years old. Here's the things that he likes. He likes Nintendo, so he bought Nintendo. He bought this is a VFC, which is Vans and North Face. He bought that. He bought Monster Energy, Monster Beverage Corporation, and he likes to go to Zoomies, so he bought Zoomies. Right? Zoomies cost him $24. He bought 2 shares. Or you know what I'm saying? He's made 15% on that Zoomies decision. He's made 17% on that Monster decision. This is not like rocket science, right? So I think what I'm hoping that you get from this is that you don't need to have a lot of money to start. In 2 months, just really quickly, in 2 months, he's done no work. He's done nothing at all but be a kid and play video games. And in 2 months, he's made $47 doing nothing. That's more allowance than he probably would have gotten in the 2 months time span, right? He made $47 in 2 months doing nothing, okay? I'll go back to show you Aaliyah's account.
Can you talk to them about what you need to do to set up their account? How you have to be the parent, whatever it was?
Yeah, we could, I'll talk about that in a second. Aaliyah has done nothing. Only thing she's done is sit around and make $70.15 off of stocks that she chose. I didn't choose these. The only thing I contributed of that $70, I contributed $30 because I chose VOO. She made this $13.93 herself. She made this $14.12 herself. She made that $12.08 herself, right? With doing nothing but being a kid. And as time goes by, that's going to grow. So I share all that with you guys to say, don't let this thing intimidate you. You could be as young as 18, 19, 20, or you can be as young as 7 years old and choose your stocks. Okay? So any questions about any of that before I move forward? Anybody? All right. So for those of you that have kids, what Nate was alluding to, are these 3 accounts are custodial accounts. So basically, they're their accounts, but I manage it. So and it's their money. So I actually can't pull the money out because it's theirs. It belongs to them. But they can't get it until they're 18. But the good part about it, because there's with kids, a lot of times what they'll sell you is a 529 plan, which is for but that 529 plan is very specific, and it can only be used for college, right? So if your kids decide they don't want to go to college, don't want to do college or whatever, then what do you do? What happened to all that money you were investing for 18 years, right? So with the custodial account, it's just like having a regular stock account, and they can do whatever they want to do with it whenever they want to do something with it, and this will grow over time. So for those of you that care, we'll see how I did. I don't remember what the number was last week. I think it was 6,000 something. Anybody remember what that change was? I told y'all I bought Twitter last week, but I didn't buy anything this week at all. And I think I made it that over $1,000 in a week, and I've done nothing. Right? All I've done is just sit back and watch these stocks grow. That's all I've done. And look at this. Right now, everything's
stocks are growing.
Everything's great. But let me tell you why. But why is that though? Why you see all this stuff in the green?
Oh, I know. Yeah, I got you.
The economy's about to open back up.
Huh?
The economy's about to open back up.
The economy's about to open back up, but here's the important thing, guys. Because I'm gonna show you a stock. I'm gonna show you this stock that over time never goes down. Never.
AT&T.
Not AT&T.
AT&T going down.
And so what's happening right now, I started on March 25th or something like that. It's a liquidation. It's been Black Friday. We've been having Black Friday sales on stocks. Right?
Time to get in.
It was a time to get in. And so the other thing about this, a lot of times folks will start saying, like, I missed it. I should have did this. Like, there's 2 times where you should invest. Like when the stocks are low and today. The first time is like 10 years ago, and the next time is today, right? Because it's going to go up 10 years from now. You're going to wish you would have got in 10 years earlier.
Yeah.
Right. So the reason why all these things are green is because I bought them when they were cheaper 2 months ago. So it's never too, and I didn't, and these grades, I ain't paying attention to none of these grades. I got my own.
Yeah, we didn't talk about the grades, did we?
We didn't talk about no grades. You know why? I don't let somebody else tell me that Walt Disney is not a company. Walt Disney has an F? Get out of here.
Get out of here.
It's Disney.
Numbers when we looked at it was good. Remember last week, me and you and Cog?
Yeah, I'm not hearing that, right?
Yeah.
So make your own decisions. Don't let other people make decisions for you. You know what I mean? So any questions about anything that I've shared? 'Cause I'm about to leave this page.
So can I add something?
Sure.
I just want to add that a typical gain in a year is between 8 and 12%. in a year. So we're talking 13% in a few months. That's pretty good, Omar.
Thank you. Not bad. Not bad.
I have a question.
Yeah, go ahead.
What's your typical, say, percentage of your net income that you invest?
Okay, so let me give you guys a little perspective. So what I did was I refinanced my house. And when I refinanced my house, I pulled some money out of the house because my house I live in California, so my house appreciated. I bought it for $335, and now it's worth at least $800, maybe more. And so I pulled $175,000 out of the house, and I paid off all my bills, so I don't have any debt. I'm trying to be like Facebook. I don't have any debt. But then I was like, all right, so what am I do with this other $100,000? Right? Like, what am I gonna do with the rest of this money? Just let it sit in the bank and I was like, nah, I had plans. I pulled that extra money out because I wanted to invest it. I didn't want it to just be stuck in the house. I know I'm not moving no time soon, right? So I was like, I'm gonna invest that money. So I pulled the money out to invest with. And now that I have all my stuff placed, then I started looking at my, and this is like connected to personal finance, but I started looking at my pay, right? And so what I noticed is because I don't have no credit card payments and because I paid off my cars, like the money that was going to those things don't have to go to those things no more. So my car payment, my old car payment, my old credit card payment, those are going into the market now, right? So what you might want to think about doing as individuals is one, assessing, do a dive on your account and try to figure out, do I have some extra money? And if you don't have extra money, the chances are you don't have it because you're paying for you're paying interest rates on your credit cards probably. That's probably why you don't have no extra money, right? So try to think about how can I lower my debts so that I can have extra money and be able to reallocate those funds, right? So really when it comes down to it, you do whatever you can. You know what I mean? Like, again, you don't need a ton of money. Like I said, if you wanted to buy AT&T, you could for $30, right? So it's just a matter of like figuring out, how you can kind of get in the mix. I wanted to show y'all something. Was this the page? Shoot, where is it? Hold on.
While you're looking out, only reason I asked that question is because it's always been a question for me. And maybe if there are any, I know Nate is a financial professional, but what you need to have in cash reserve versus what you invest.
So what I did, I'll tell you what I did, and this is just my own personal opinion. So one, I wanted to eliminate my debt. So there's a thing called a debt snowball. And you ever heard of that? Thumbs up, thumbs down. All right. So,
heard terminology.
All right. So a debt snowball is you got two ways to attack debt. Number one, you can take your highest interest rates and like try to pay off those cards or whatever first, or you can take your lowest balances and pay off those first. And the reason why you do that is because it's much more satisfying to like knock out stuff and it's motivational. And that's the debt snowball. Yeah, so with the debt snowball, so like for example, if I have a credit card that has a balance of $750, I got another one that's got a balance of $3,000 and another one's got a balance of 10. So let's just say the one that has the balance of 10,000 has the highest interest rate. I'm not feeling like I'm accomplishing much by trying to like attack that one because it just went from 10,000 to 9,830, right? But what happened if I were to take that same $200 and put it on that $750 card? Now it just went from $750 to $550. I'm feeling some momentum, right? And so then once I knock out that $750 card, now I can take the money that I was putting towards that card, and then kind of double down on that $3,000 card, right? And now when I knock that $3,000 card, I can now knock out the 3,000. I use the money I was using on the 3,000 and the money I was using on the 750, and now start working on the 10,000. So doing that first is like, it really important. Then the next stage of that, there's a guy. Maybe I'll put this as your homework. Guy called Dave Ramsey.
I was about to ask, isn't this the Dave Ramsey method?
It's one of Dave Ramsey's methods. Yeah.
Okay.
I like Dave Ramsey because you don't have access to old Southern white men. so I like to listen to him. He's an old Southern white man that probably is not talking to me necessarily, but he's got a following. He's got a huge following. So he would tell me to knock out the debt. And then the other thing he would tell me is to have like 3 months of expenses reserves in your account, right? So basically what I did is I looked at my account and I was like, when I pulled that money out, I looked at my account and I was like, all right, I need about $30,000 just saved somewhere in case of an emergency. In case coronavirus comes and I get furloughed, right? I need to be able to have 3 months to be able to pay my stuff off. So I got $30,000, but I didn't put it in the bank. I didn't put it in the traditional bank. I put it in a high yield savings account. And so my high yield savings account is with Ally. I think regular savings account, you might get 0.0001%, whereas Ally is a little closer to 1%. And that $30,000 that's sitting in there right now, I think I made $26 off of it in interest this past month or whatever, right? So, but that money is just there in case of emergency, right? So in terms of your question, James, like, if we haven't learned anything from what's going on right now, like, you need to have some reserve somewhere in case shit hits the fan. And this is like shit hitting the fan. Like, if this is an example of just people losing their jobs, not having opportunities, and you want to be prepared for that. And so the investing part of it, like, you don't go broke investing, right? So you definitely but you also have more money than you think you have, right? So that's just like a personal finance play. Good question.
Don't buy those new Jordans.
You don't need those new Jordans right now. You can go buy Nike before you buy the Jordans. Nike's going to be cheaper anyway.
Yep.
The Nike stock. Matter of fact, I'm gonna have Brian show you. I'm gonna have Brian teach Kendall about Nike stock. That's what we're gonna do next. We're gonna see if it's worthwhile investing in Nike. But I wanted to show you guys this. This is a trip. So check this out. This is we looked at AT&T last week, right? We talked about dividends, right? So this is gonna blow your mind. I want everybody to check this out. This is crazy, right? So let's take a date on AT&T stock. Let's change this to 2000. Shoot, let's go 2008. Why not? And let's say September 2nd of 2008. Nope, that's not a good date. Let me choose. Let me choose 2005. Nope, don't want that either. Where was my number at? I randomly landed on it. 2009. Nope, that's not what I want. Hold on, let me cheat a little bit. I just want to show you something that's like mind blowing. All right, let's go 2016. Let's do 2016.
7-Eleven.
Okay, let's do July 2016. Okay, that's cool. Man, I want to be more than that. Let's go. There we go. All right. So here's what I wanted to show you, because this is a trick. So if you bought AT&T for 40 on July 24th on June 15th of 2016, 4 years ago, it would have cost you $40.29 at the time. You with me? It cost you $40.29 at the time. today, the stock is $30.86. So let's just say you have one share that you bought in 2016, one share, and you pay $40 for it. When you look at this, it's telling you I lost $10 on that share, right? Check this out. I got $8 over that same time period. I got $8 worth of dividends. And so even though I think that I lost a much larger percentage, my total return is actually not that.
Wow.
That would have been reinvested in the share price, right? Or in your shares, right?
Because they've been paying me. Even though the stock went down, they've been paying me.
Wow.
Right? And then if I go even further back when the stock was like much cheaper, let's just go to 2000, whatever. Oh, that's what I did. So check this out. This is nuts. Check this out. Look how crazy this is. Look how crazy this is. I bought this stock in 2000. I got one share. This is what I did. Now this is the one that blew my mind. I got one share. Today, that share is worth $30.86. I bought it for $48.56. I lost $18. But somehow, some way, I got a total return of 30%.
Whoa. I didn't even know that.
I made money on the stock, even though I lost money on the stock.
It can buy another share.
And why did that happen? Because of the dividends that we talked about last week. Because I got paid, despite the fact that I lost $18 on the actual stock, I made $32.42 off of dividends.
Mm-hmm. Now, multiply that by 10,000 shares.
Now we're talking about one share. And what we're talking about is the worst case, not the worst case scenario, but a pretty bad scenario. I'm losing $18 per share. Y'all can help me with the math, but that's like almost like 40%, right? Somewhere in that range.
Yeah.
Mm-hmm.
I lost a ton of money on that share. Somehow, some way, I ended up with a total return of 30%. And what Cox told you earlier, in regards to a stock, you're hoping to get, on average, 8 to 12%. I made 30% on a stock that lost money. What y'all think about that? What y'all think about
that time in?
Why you got to hold and not worry about the ebbs and flows.
All right, so I missed it last week with the dividends. Explain exactly how the dividends worked in your favor.
Go ahead, Jason. Explain, Jason.
Yeah, homework, Jason.
Jason.
Answer his question.
Diggs.
Oh, dividends are, I don't know. Dividends are paid out as a return, as a part of the return on the stock that you get. So it's separate from the actual price of the share. So it's, growth versus dividend stocks. Something like that.
You put some more.
You dig it.
All right, go ahead,
That
Brad.
told me nothing.
It could be monthly.
Okay.
Well,
it could be
Go
quarterly.
ahead, Brad. Add on to it, Brad.
No, it could be monthly. It could be quarterly. It could be yearly. And it's kind of like them. I thank you for investing in their company.
All right, cool. So
and I made a good purchase today. What? $30, baby.
Yeah. They dirty.
Because often at tax time, you often see some of those, when you get those, I can't remember what tax sheet it is, but you see those, I guess, dividend worksheets for when it's tax time.
Yeah,
1099s, 1099 dividends. So I guess that's a lot of that dividend money that you either make or what have you.
Here's the key to that though, and I want everybody to remember this. You got two options. Option number one, no dividends come, we'll send you a check. Right? If you want to do it that way, you can collect your money like that. Option number two is you reinvest the dividend. Right?
Yo,
So you haven't.
I'm sorry. Oh, real quick. Yeah. Whoever has their mic open, that joint is real distraction. Can you like mute your mics while people are talking?
All right.
Thanks.
So you can collect a check, right? Or you can reinvest your dividends. Okay. So if I'm reinvesting my dividends, what's happening, Brian? If I'm reinvesting my dividends, what's happening? Let's say I got one share AT&T. Let's just use this one we see as an example. I got one share AT&T I got in 2000, and I've been reinvesting my dividends. What's happened? You gotta unmute yourself. Still muted.
So basically you're compounding your interest, your dividend from your other balances. So your dividend is rolling over into your balances, buying more shares. It's compounding over time.
Okay. All right.
Okay. So basically, essentially what he said is I start off with one share. When I get paid my dividends, as Brad said, either quarterly, annually, twice a year, whatever, if the dividend is, let's say 50 cents, right? They pay out 50 cents. That 50 cents, if I reinvest it, goes back into buying like fractional shares of the stock. So instead of me having one share, now I have 1.002 shares. But here's the thing. The next quarter, when they pay, they're not paying me on having one share. They're paying me on having 1.002. So then when the next quarter comes, they're paying me on having 1.007, right? And that's the idea of compound interest, right? Because you're making money on top of money, but you're getting more money along the way. So that a situation could play out to where you could buy a share for $48.56. You could lose $18 on it and still be up 30%. But that only happens over time. It took 20 years for that to happen, but that happened over time. And again, this is one share we're talking about.
All right, so say for instance, you wanted to cash out on that stock.
Why would you?
I'm just saying.
You could, but let's say, so here's what happens. If you have, let's say you have 10 shares, okay? And you're like, I made some money on it or whatever. Like, let's just say you have 10 shares. If you decide I want to sell 5 of them, now you're only getting paid dividends for 5.
I got you. Yeah. I got you. Yeah.
Versus getting paid dividends off of 10. So let me present this to you. Hey, Mike, welcome. Mike, glad you're here, brother. And I'm actually going to bring this question to you. Are you frozen? It looks like you're frozen. Mike frozen?
Frozen. Forget that.
It's supposed to be frozen. So I'm gonna bring this question to you. If you had
I'm not frozen.
Maybe it's just on my
end. I'm not frozen.
So let me ask. I'm bring this question to you. If you had a choice between putting your money in a savings account.
No, I'm not.
What happened there?
You need to get off AOL, bro.
You're on that Cricket Wireless, I'm telling you.
Oh, man.
That Teddy Riley line.
Okay.
So if you had a choice between putting, let's say, $1,000.
Yo, y'all crazy.
Putting $1,000 into a savings account versus $1,000 into, say, a dividend stock. Based upon that information that we just gave you, which one might you be interested in doing?
Well, from what I've already learned about dividends, I would be more prone to put my money into the dividends because I'm thinking long term.
Right. Oh, okay. Well, there you go. Joe, answer the question.
See, I'm still a little torn because I'm that conversation that you had earlier about having 3 months in savings and stuff like that.
Yep.
I'm actually really close to getting to that point right now. Right? So I'd put it into dividends, but I'm still trying to build that cushion to make sure I'm good, when things hit the fan, because I just refinanced my house this past week.
Okay.
So I'm actually doing that same thing right now.
Yeah.
Because my interest rate just went down, and I'm pulling money out so I can fix up things in the house that are broken, but also to invest. So I'm kind of doing the same thing already without even talking to you.
Yep. So check this out. Last week we talked about dividend aristocrats. Young Rob, you want to explain to the group what what's dividend aristocrats? You remember that?
I do not.
Company that continue to pay dividends. We just talked about it, man. That's what we just said. The company that continue to pay dividends, that increase their dividends year over year.
All right, so I'm gonna show you guys so that nobody has to guess. Dividend aristocrats. This is important. So check this out. In order to be a dividend aristocrat, dividend aristocrats are S&P 500 stocks that have increased their dividend payout for 25 consecutive years or more. That's the only way you get on the list, is if every year for a minimum of 25 years, not only have you paid out a dividend, but you also increased a dividend annually for a minimum of 25 years.
Consecutively.
So if you take a break, you off the list. Okay? Now, there are 64 dividend aristocrats. I'll show them to you. They have their own ranking. We're not worried about the ranking right now, but this is what I want you to look at. Johnson & Johnson has been paying out a dividend consistently and increasing it consistently for 57 straight years. Procter & Gamble, 63 straight years. That toothpaste that you got in your bedroom, you've been paying out dividends for 63 straight years.
All right, so hold on 2 seconds. Before anybody starts putting a whole bunch of junk, stuff in Johnson & Johnson, then they just get found for putting like arsenic in like baby lotion or something like that. So I would imagine that would be something you kind of want to stay away from. Is that right? Or do you end up just going to buy low now when their stock is low? And you'll probably get to that later.
Hold that, because after Brian shows Nike, we'll look at Johnson & Johnson and make that determination.
Yeah.
So automatic data processing. Anybody outside of the computer science world even know what that is?
They do payroll.
How you get paid, baby?
I have no idea. But what I do know,
they process my payroll, my company's payroll.
What I do know is they've been paying a dividend for 44 straight years. Right? Same thing here. 42, 28, 57, 56, 33. Here go Coca-Cola right here, 58. So the reason why I shared that, and there's 64 of them, so you can go and look at this on your own whenever you feel like it. But the reason why I shared that is, do we think Coca-Cola is going away anytime soon? Are they going to decide all of a sudden to not pay a dividend anymore? Nah. And so when you look at something like Coca-Cola, you'll see that Coke, let's go back over here real quick. You'll see that Coke, they've been paying out consistently for 57 years. And a lot of times, some of these dividend stocks, you'll notice very little change in their stock prices.
That's right.
Because you're not making money off the stock price. You're making money off the dividend, right? So if I go back, let's just go back that same 10 years, 2, 3, 2000, whatever. Their stock price back then was $27. Now it's 46. So it's had some growth. Obviously, stock has gotten Coke has gotten bigger since then, right? So that looks like I doubled my money. But look, the total return is 135%. For
4% annualized compound interest.
from 20%. So let's just go to 2010. Let's say you only did it for 10 years. It's 117% per share, right? Are you making 117%? 117, and let's just say you put that same money in a savings account. Would you make 117% off that off the money in a savings account?
So real quick, because as you're showing this, the first thing that comes to my mind is asking, how do you know that if you're paying too much for a stock?
I got an answer for that too. Brian's going to tell you. We got an answer for that. We got an answer for that.
We got an app for that.
We got an answer for that. But what I want is, but again, what we're talking about here, I've shown you guys a 20-year example of 135%, a 10-year example of 117%, and a 5-year example of 30%. And none of those numbers are anywhere close to what you're going to get in a savings account. And you know, Coke ain't going nowhere. Ever. Like, it's not going nowhere. So that's just some added stuff that I want to share with you guys about the dividends that we talked about last week. But let's get this thing kicked off. Brian's ready. He's going to talk about Nike, right? I said Nike?
Yeah.
We're going to do a full run through?
Yeah.
Cool.
All right. So the first thing for the new folks, first thing that we look at, you tell me what to do, Brian, and say it out loud, and I'll do it.
All right. So first, we want to go to the key data set.
Before we do that.
I guess we'll. Wait, do you want to get to the website or just start?
No, before we go to the key data, what are we going to do before we do that?
Expand the chart. Just expand the chart.
To what?
For 10 years, I believe.
5 years.
5 year. Sorry.
And once I do that, what am I going to look for?
Well, you're going to look for it to consistently increase over time from the beginning. So the chart should go up over there. Stock price should go up over time.
So based upon this chart, what would you hypothesize just looking at this chart?
Well, it's been a pretty good stock. It's been increasing over time since over the 5 year period. So it has gone up to over $100. So it's been a pretty good stock. So I would buy the stock just from looking at it from 2020. But knowing what I know now, then I would still buy it because it's still higher than what it was, and it's still going up. Like at the end of the 5 year period, so it's still increasing.
Would you maybe
I mean,
more in detail?
Well, we're not talking about that yet, but I would add to what Brian said. I would say during this span, maybe it's 2000, maybe it's still 2016, but during this span, it was relatively stayed about the same, right? Something happened around this time that really shot it up. So somewhere in 2018, 2007, late 2017, early 2018, something brought this trend in the right direction, right? If we wanted to pull out to 10 years, you'll see it'll be a much more smooth, steady growth of the company. This signifies growth, right? This signifies growth. And that's what we want to see, right? So just really quickly, right? I'm gonna let Brian finish, but just No, this ain't what I want to do. I did this last time. We looked at AMC, right? So if I did the same first step, right? And I put over a 5-year period or 10-year period, whatever. Let me do 5 years. What I notice here is steady decline before coronavirus. It's been declining before there was ever, coronavirus didn't happen until here, but it's been declining ever since, right? And so the first week I shared stupid mistakes made by, new investors 101, which I did. And I was just like, man, they used to be, $12 and now they're only $3. So I guess I should buy it. Like, this chart is telling me that was a horrible decision. I happen to make money on it, but it was a horrible decision, right? So that's why you want to go that 5-year first to just get a general idea of if this is even worth digging into it some more, right? So that's where we're at first. So now that we've done that, we've agreed that we're seeing some growth with Nike, and if we want to look out a little bit further, we've seen consistent growth with Nike over the 10-year period, right? So now we want to go to key data, right?
Yeah.
All right. What are we looking at first?
So now we're looking at the total revenue versus the gross profit. And you want to look for, it's basically the bold print at the top under revenues. So you want to make sure that your revenues is outweighing the cost of your revenue. So it's staying consistent over the 5-year period, 4-year period, 5-year period that we have here.
All right, so what he said was we're looking at this total revenue, which is money that's coming in, right? You ain't paid no bills yet. It's just money that's coming in, right? And what you'll see, you can either look at this graph and eyeball it. You see that the revenue's been going up consistently over time, right? And the other thing that you notice with the numbers, this is $30 billion in May 2015, 32 billion, 34 billion, 36 billion, 39 billion. And from today, 12 months back from today, we're talking about 41 billion. So it's not crazy growth, but it's growth as it relates to the revenue, right? Then you said, what we're gonna do next?
So as we look at the profits, we see that it's increasing and going up.
So we see
with the other blueprint. So the cost of the revenue is, well, the total revenue is greater than the cost of revenue. So the core profit is going up year over year at a time.
Yeah. So
it's maintained. It's constantly going up.
So this is how much I made. This is how much I brought in, right? And this is how much it cost me to bring that in, right? So if I go and buy a T-shirt for $10 and I sell it for, I buy a T-shirt for $16 and I sell it for $30, I made 14. That makes sense, right? All right, go ahead.
All right. So then we were looking at the operating income. So that's been generally consistent over time, and then we'll go down some more. And we're looking at the net income. And
what's something that we noticed on the net income?
That it's been fluctuating a little bit. So like in 2018, it's gone down. So it's not as consistent as it should be. And something happened during that time period because it lost like $3 billion.
I know what happened. Yeah, $2 billion in tax expenses. State income taxes, $2.3 billion in income taxes.
Oh, okay. Oh, that was neat. I thought it was Kaepernick.
Okay, so something happened here, but relatively consistent in the income that they're bringing in, right? And then there's one other thing that we kind of want to look at on this page.
The revenue per share. No.
Right here.
Per share.
Earnings per share. So for how much money am I getting per share? It goes from $1.90 to $2.21 to $2.56. That whatever happened, that event that happened that year went down, but then it just bounced right back. Right? And then the other thing that we can look at is, guess what? Nike is also paying dividends. Right? They're 54 cents, 62 cents, 70 cents, 78 cents, 86 cents, 93 cents.
Even the down year, they went up
Even
pretty.
down year, still the dividend per share still went up.
They did the normal 8 cents increases per year.
Yep. So those are the things that we looked at. So far on this income statement, we feel pretty good. Right? All right, Ronnie, you doing the balance sheet?
All right, let's do it.
Good job, Brian.
Put the money in the wheelbarrow. You in Egypt, guys.
Oh, all right.
What are we most concerned about on the balance sheet?
Assets and liabilities.
And what does that mean?
Liabilities, you lose money. Assets gain you money.
Assets are things that's going to make us money, and liabilities are things that cost us money.
Yeah.
So
now,
what do we want to have happen in that situation?
You want more assets than liabilities.
Want more assets and liabilities, and so we have two different kinds of assets, right?
Yeah. Where's this? You got the current assets and you get the long-term assets.
And did we ever talk about what that was? The difference between the two?
I don't think so.
Rob, you want to share?
So your current assets, if you look at them, what you'll see is like all on the long term, you see all this depreciation, all that stuff down here. Basically, short term,
that's like infrastructure.
Really, yeah. So short term is really just like kind of what you have on hand, right? That's not getting the benefit of depreciation or anything like that.
So for Nike, Rob, if I can add in, it would be their inventory that they're using to sell for their revenue, right? So they do about $4.567 billion in purchasing of inventory, which is their shoes, shoestrings and stuff, the thing that they do to produce money, right? So current assets would be that. Another thing for long-term assets would be like their buildings that they build, their warehouses that they have, you know, that are longer term being depreciated over a period of time. So those are the longer term assets.
And we talked a little bit.
Goodwill is another thing. So you don't have to have goodwill first and foremost. It's not something that any business has to report on. But goodwill is a number that a company comes up with to determine how much they think the public, you know, views them, if you will. All right. It's not a tangible asset. There isn't any true dollars linked to it at all, except for during an acquisition or a purchase. Okay. And so it's really just a non-tangible asset that you may or may not assign to it in the company. For large companies like, you know, those S&P 500 and those guys, they will have goodwill because they've established goodwill. Like, you know, Nike as a brand, and you assimilate him with Jordan. Excellent. So they've established a goodwill, which is $131 million, right? But it's not something that you have to have. It's non-tangible.
All right. So when we're
I have a general question.
Yeah, go ahead.
So in the trailing 12 months or the last column,
yeah,
I'm asking this question because I've seen it in other areas when I was doing additional research. There's usually some stuff that's either unreported or just doesn't have anything represented. Does anybody have a general answer as to why that is? Like if you look at the long-term assets in the last column, the gross property and accumulated depreciation, there's nothing reported in the last column. It is in certain areas, but
those are a lot of those are calculated numbers to get to the numbers you see there. Some of them are projected numbers, right? And some they won't report. So in general, I don't tend to look at the trailing 12 months because those are projected numbers. Those numbers are still being produced. We're in the current year that those numbers are being produced. So I wouldn't necessarily worry about those numbers. As a an investor, I'd rather worry about the ones that actually happened. So 2019 to previous.
Yeah. So hold on. So just as to not confuse anybody, when we're analyzing these stocks, we really just care about the stuff in bold for the most part. We can definitely get into the weeds about, man, their inventory is going up. You know what I mean? Like we could do that if we wanted to, but really on this page, as Ronnie shared and he's getting ready to explore, we only care about two things: assets versus the liabilities, right? And we want to have more assets than liabilities. We want more money coming in than what's going out, right? So go ahead, Ronnie. What do you see? What do you see with the total current with the current assets and the total liabilities? And then tell us about the cheat code at the end.
Oh yeah, I was just gonna go to the cheat code, but
the cheat code. So explain before I go to the cheat code. Explain it.
The cheat code down there when we get down there is gonna do the math for you basically, but so you don't have to scroll up and down and try to do the math. Where is it? Where's the cheat code? Where is it at? Is the equity right? Where is it at? There it is. So based on this,
what does that mean?
It seems like it's going down a little bit.
But before you go, whether it's going down or not, what does the number mean?
Oh, is the assets minus the liabilities.
Right. So they have $12 billion in assets after all their liabilities are accounted for. Right?
Right.
That's a good thing.
So, right.
And if you're Warren Buffett and you're looking at Berkshire Hathaway, it's slightly higher.
Really quick, would there be a concern considering that you see it go down by $3 billion, close to $4 billion? And is that a trending thing?
I guess you could say that, but another analysis that we'll get into is if the peers are similarly doing the same thing.
Yeah, so that's a really good question, Joe. First, I got to make a determination: is there a huge deal between 12 billion and 9 billion? Right? I got to make, because it's still positive, right?
Right, it's still positive. It's trending downward, but you're still in the red. I mean, in the green.
So, but let me do this. Let me do this, Joe. So I can help you try to answer that question, right? So, if we go to the current assets, right? We'll see 15 million or 15 billion, 15 billion, 16 billion, 15 billion, 16 billion. So that number is not really changing that much, right? Then when I go to the liabilities, I'm seeing 6 billion, 5 billion, 5 billion, 6 billion, 7 billion, 8 billion. That's not really changing that much either. So there has to be something that has made this equity over these last 2 years throw off somewhere, right? So I can look through all these numbers and see like where these crazy anomalies are at. And right here in these long-term liabilities, I noticed that these numbers jumped, right? 8 billion, 9 billion, then it jumped to 12 and 14. And then I got to ask myself, well, why did it jump? Well, they had long-term debt of only 1 billion here, long-term debt of 1.9 here. Now we're talking about 3.4, another 3.4, another 3.4, right? So their long-term debt shot up in ways that it hadn't before. And I could probably dig some more to try to figure out why or what happened there, right? But you can start to try to answer some of those questions by just going through and looking for like random anomalies, right? And this is the job when people like Nate who go and look through people's books to try to figure out like what's happening here, right? But for you, go ahead, Nate.
So really quick, I'm a numbers guy, but I'm also a numbers guy that looks for context. So even though there's a lot of numbers here, there may be, other data sitting out there saying why this is happening. Do you know where that's located as well?
Yeah. So so there's two things, right? The first thing is what Ronnie said. We want to know. We want to take note of this. We want to take note of it, and what we want to do, what we'll do later. We're not there yet, but I'll just show you. Is we're going to click on this peers, and we're going to find Nike's peers.
Okay.
And we want to see if that same kind of anomaly happens with some of their peers, direct peers. Now, what we're going to see when we go to peers is that there's going to be some unusual peers there. You're probably expecting to see Adidas, Reebok. I can tell you right now, you ain't about to see no Reebok under peers. Right? Because the peers come more about it's more monetary than it is like direct business correlation. Because Nike's a mega, right? And it's bigger than Adidas. It's bigger than some of these other shoe companies. So that could be one
question for you.
thing. But yeah, let me just finish this question real quick. Then the other thing, Joe, what I talked about over the last couple of weeks, which is super important, is to get, if you really want to get some answers,
investor.
You go to fill in the blank investor relations. So I can go directly to Nike's page and go through all of they got everything here. They're going to tell me everything, right? Anything I want to know, news, events, quarterly earnings, annual reports, SEC filings. The answer to your question is actually
probably a stock split, though.
Huh?
Probably a stock split or something.
It might be. But the answer to your question is probably in this SEC filing that people have to do these 10Cs or whatever, in SEC.gov. You can scroll through that their actual, like what we're getting right here is a snapshot.
Yeah.
This is a snapshot. The real digging exists on those on the SEC filings. That's where the real answer is. That answer your question? Joe?
He nodded.
Okay.
Yeah, thank you. I didn't want to, yeah, that worked.
All right. So what we've seen here is the total equity. This is the cheat code. We ain't got to look at none of these other stuff. We don't want to. But for the most part, we want to see that money is stable. We got some questions about this, but we're still talking about this is positive, right? It's still positive $9 billion.
Yeah, so that was my question. So is this just, you kind of answered it. What does that mean in relation to does it mean anything in relation to the stock, or are you just looking for like a comfort level? Like, okay, I'm comfortable with.
Yeah, so to really, really answer that question, we got to look at the peers. We got to look at the peers.
Right? Can I reiterate asset liability real quick? My little take on it.
Go ahead.
If you don't mind. So you got to remember that an asset is what you got. I know this sounds simplistic, but I cried because I could not understand this to save my life in grad school. An asset is what you got. A liability is something that takes money out your pocket, either now or in the future. So asset, what you got. And then liability, what's going to come out. And then what's left over is equity. That's what's left over. There you go. That's it.
That makes sense.
Black people need equity. Anyway, sorry.
So to really answer the question, Kendall, like we want to be bringing in money, right? Like we want to be positive. I want to be making money and not losing money.
Yeah,
right?
It makes sense.
And who do we look at? Was it Ford? Who do we look at last week as a comparison, real quick? I think it was Ford. Let's look real quick. Just so you can see the other side. I think it was Ford. I'm not 100%
Oh,
sure.
yeah, it was Ford because you will see it. It looked like it was hurting.
Nah, it must not have been Ford. It was somebody. It was somebody else, but it was like this was like negative. I don't remember who it was, but they were just hemorrhaging money, and it was all bad. I don't remember who it was, but we want to see positive. We want to see something positive.
Paying out too much dividends. Who was that?
I forgot who it was.
That was a candy factory that.
That was
Oh, that
James'
candy
joint.
one.
Yeah,
Yeah,
James one.
it was the candy. It was the candy one. All right, so now we're gonna look at the cash.
Yeah, look at the peers.
We're not there yet. I'm looking at the cash flow first. Who wanna do this? Let's Brad, you wanna do this? It's cash flow.
Nah, I'm gonna stay out of that.
Feel comfortable?
I gotta get the first part.
James, that's okay. James,
I'm actually rusty at this myself.
James, you feel comfortable looking at this cash flow?
I mean, we can go through it. We got help on the line, so
Yeah.
I
So
think we take the same approach.
Yeah. I brought brothers to understand something, right? So we do these classes. I mean, I could talk to you for 2 hours, but you're not. No, the person who learns is the person who's talking, right? So it's okay to be uncomfortable. It's okay to not have the right answer. Nobody expects you to have the right answers. But I want folks to learn, and you're going to learn when you're trying to explain, right? You're going to have epiphanies when you're trying to explain. So I want brothers, push themselves as much as they can to take some risk. We're not going to kill you for it. And you got some really smart people on the line that can just correct anything that you say wrong. So in general, what Ronnie, or who was it, what Brian said earlier, for the most part, we're looking at the stuff that's in bold for the most part, right? Because that's like the simplest way to look at it. And essentially, we want to see things going up and not going down. Like
there it is.
And that's that what I just told you is what my 8-year-old daughter used.
8-year-old daughter
to buy Etsy. That went up 15%. So it doesn't have to be confusing. So all right, James, let's go to what we're looking at on the cash flow.
The one thing I did see when I was doing additional research is that the net income is pulled in from, I guess, the previous page where they had already calculated that. So that kind of gives us a baseline at the top.
Yep,
and then we're looking at all of the other bold areas. So we see the cash from operations. We're seeing that is somewhat shifty, but I guess still within range. Going up and down, I think. Yeah, so I always pulled up the graph and showing that over the last, I guess, 3 years, it's progressively increased.
And that's a good thing.
And I guess
we want to see some positive. This is important. Nate, can you share just real quickly a definition for cash for operations?
Sure. So we're looking at Nike, and basically Nike sells shoes, right? Or they sell apparel. So whatever it was that they used to buy the apparel, to then making them into the Jordans and then sell them to the public is cash from operations. All right. Their activity of what they do is produce T-shirts and Jordans and whatever, and it actually translates into money is cash from operations. And after that, there's a lot of things that go into it: overhead, inventory, how much it costs for the inventory to pay for it, the short-term and long-term depreciation. So all those things factor into what cash from operations is. Okay? But primarily the thing that they look at is the overhead and the inventory that it took to get these stuff into position to then sell it.
So this is the money that they're making from their operations, right?
Right.
Right.
Hey, Nate, are they holding that inventory on their books, do you think?
So sure. So if you look at, over the course of a quarter, let's say they buy, 1 million, shoes to make the latest Jordans. They're all not going to sell in that quarter, right? Yeah. So they'll, at the end of each quarter, they have to do their financial statements, have the auditors audit them, and then make sure that they're good for the, for the quarter close to do their dividends and things of that sort. So there's always going to be inventory held over from quarter to quarter and even from year to year, and that's fine.
All right. So
the change in inventory is, and not to get too much detail, it's they had 620 million worth of inventory in their hands for that year. The year previously they had 590, and the year next to that 231. What's good is You don't want to have a lot of inventory on hand, which means you're not selling anything, right? So you want that to decrease year over year. Now, the only thing though that's a little different is they may increase their inventory when they're coming out with a new set of Jordans, which might make the inventory on hand look different. But from what they do, the inventory should be pretty steady. They should know, how their stuff's going to sell, and it should always go down from that perspective.
All right. So thank you, Nate. Now I want you guys to understand two things. One, Nate is a CPA, so he knows all this stuff. You don't have to.
No.
Only thing you got to know is I see in bold cash from operations. I can look at this graph and it's going up. You ain't got to go know any of the rest of that stuff. What he just explained. Now, if you want to know and you want to understand it, to dig a little bit deeper, you absolutely positively can do that. You can do both. And so that's really like the general feeling as it relates to stocks. You can get fully into the weeds. You can get fully into technical analysis. You can start like really chipping away at this, that, and the other. You could do that, or you could simplify it. And our level, our version of simplifying it, and when I say our, I'm talking about as a people, our level of simplifying it will be, I looked at the 52-week chart. It was selling for 80. Now it's selling for 50, so I should buy it. That's not a good reason to buy a stock, right? You need to know a little bit more than that, right? Or you're saying, I know it's going to go up one day. People going to go to the movies again one day, so that's why I should buy AMC. Well, we already looked at the AMC's chart. We saw that AMC was a failing business before coronavirus, right? So that doesn't mean I should start investing in a failing business. Or somebody says, well, Hertz about to go bankrupt, and they stock is real cheap now, they're going to bounce back after this coronavirus. Well, how you know that? Based on what, right? And so what we're talking about is looking at these stocks, and you don't have to know everything, man. Like I'm saying, you could get into the weeds if you want to, but what we really want to know, let's look at the bold, right? And we see from cash from operations that money has been going, well, they had a good year this year, 2015, went down 2016, bounced up a little bit in 2017, bounced up right where they needed to be in 2018, and then hit it again in 2019. So they're doing good on their cash from operations. There's also a cheat code on this page too. We haven't gotten there yet, but there's a cheat code on this page too. All right, James.
Let me get back. I was looking at something. Oh, I gotta get back to the screen.
Explain this real quick. Explain this real quick. That symbol.
Hold on, I'm trying to get back to my page got messed up. I'm trying to get back to it.
Okay. I'm essentially asking what the parentheses mean.
Oh yeah, that means that's negative.
Yeah.
So that's a loss or something that you paid out, I guess.
Right. So now while James is pulling that up, when we get to the cash from investing, right, you're going to notice a lot of negatives. And in your mind, you might be saying that that's a bad thing, right?
Okay, I'm back.
Go ahead.
All right, so I'm guessing that, if I remember correctly, the cash from investing are things that we spent money on possibly to expand some of the stuff sometimes is to expand our market share or to expand what we're offering. So we're making investments in other things, and sometimes that stuff may come up negative.
Okay. So Nate, you want to say real quick in a sentence or two what cash from investing is?
He's on mute.
So no different than what we do in terms of investing in stocks. Companies do too. We also invest in real estate. Companies do as well. So the cash flow from investing activities is basically what it sounds like. They invested some other money, which is a negative, it goes out, and any return on that is a positive. All right. So and it's always going to be a negative because you're putting cash out. We're reducing our cash on hand to pay for an investment in the hopes that it'll return. And if you look at 2018, it looks like they made money actually from one of their investment activities.
Yep. So these capital expenditures are exactly what Nate's talking about. This is the money that they're spending, they're investing, right? In buildings or whatever the case may be, right? These are their investments that they're making. These are the sales that they made. Or maybe they sold some properties, sold some equipment, sold some things at the plant, whatever the case may be. And when you add up all these things, like I said, you can get into the weeds of what each one of these things are, but ultimately this number right here is this month number plus, or plus this number, plus this number, plus this number, right? And that's giving you the bottom line number right there. And it does that for all of these. So same thing for cash from operations. Although you see all this stuff, at the end of the day, that bold answer right there, they've already done the math for you. They've already done all that math for you, so you don't have to figure it out. But to Joe's point, if you wanted to, if you saw some anomaly, say maybe this year versus, well, that's not really an anomaly, but maybe this year they did really well. If you wanted to understand why, you can see one, the stock-based compensation went up, right, considerably. Their change in inventory, well, that's not really a thing. A change in the accounts payable. Well, I don't even know what that means. Who cares what it means? But I can use this information here to try to determine why some of these numbers are changing. But at the end of the day, we want to see the cash from operations is going up. And we know that this cash from investing is spending money. Honestly, for me, I don't use this to determine if I'm going to buy a stock or not. I don't use this. I want to know the cash from operations, right? And then this next part is important to me, very important to me. But James is going to explain why.
So you want to know the amount of debt that has been accrued, because that cuts into the amount of money that you make. So you want to make sure that you see minimize debt. The net debt number needs to be less than the
kinds of debt, right? We got two different kinds of debt, right?
You were breaking up. I'm sorry.
So we got two different kinds of debt.
So we have short and long term debt. Is that what you're talking about?
Yep.
Okay. So, I mean, either way with the debt, we don't want it to be, we want to make sure that it's manageable debt. I mean, because we know the debt is going to be negative, but we want to make sure that we're not seeing a continual uptick, a major uptick in the debt number, because that could impact our long-term and even short-term gain.
Yeah. So what we noticed in 2015, they had no short-term debt. 2016, they had no short-term debt. 2017, they took on some debt, $327 million worth of debt. And in 2018, they took on $13 million of debt, right? But then we also want to look at this short-term debt that's been repaid. So even though there's no debt here, they paid $63 million probably for something that happened like back here, which we can't see. Another $67 million here and another $325 million here. This $325 million here might account for this over here, right? So we see that they're paying their debts off, right? And then we can also look at short-term debt, and then you correct me if I'm wrong. Short-term debt is the debt that has to be kind of closed out in a year or 12-month time period, whereas long-term debt is like over a long span of time, right?
Yeah, it's similar to long-term accounts payable, long-term accounts, or it's long-term and short-term liability. So it's usually for the debt issued is over a year, and then long-term is half the year. So
okay. So I want to, in general, I want to look at this, but ultimately, guess what? I don't care about none of this. I want to see the bottom line, cash from financing, right? I want to see cash from financing. So go ahead, James. You can go ahead and continue.
So right now it's showing that the cash from financing that's in the negative, right? Because it has the parentheses. Can't talk tonight. Has parentheses around it. So that's accounting, and that's is that adding up everything that's in that column under it?
Exactly right. We spent $63 million on paying this debt back. We spent $26 million on paying that debt back for a total of 89, right?
Right.
And here we issued stock, $515 million worth. We bought our stock back, right? $2.5 billion worth of stock we bought back, right? And then this was the bottom line. Wait a minute.
Dividends paid.
Yeah.
Dividends paid out.
Dividends paid out. And then after we do all of this mathematics, we're going to end up with the cash from financing. And Nate, you want to give a quick definition for cash for financing?
Yeah, so it's basically all of the money that's being brought in, but is not attributed to you performing a service or you doing what your normal day-to-day
So it has
company.
nothing to do with selling shoes.
Right, nothing to do with selling shoes. You brought in cash from other sources, be it angel investors, issuing stock for people to buy into it, or you taking on debt, right? And the reason why the repurchasing of debt is on this part of it is because, or repurchasing of your common stock is on part of it because it's also how you got your financing in previous fiscal years. So you have to show when you bought back your stock.
All right, perfect. So guess
I have
what?
a question. I have
Yep.
a question. So companies can buy back their own stock in order to have money to pay off some debt? Did I get that right?
No. When you issue your stock out and people give you money, it is debt.
Oh, I see.
Because so Omar's daughter bought Etsy at $89, $68, right? The company Etsy owes Omar's daughter the $68 or whatever the stock price is. So it's not a positive. It's a positive that people want to buy your stock, but it's also not something that you can just not report, because again, people have to have trust that you're going to do right by the money that you're investing in. So the money that we're investing in the stock, they're going to use it for other operations to create new T-shirts, new Jordans, or even just buy into a new market. Maybe they want to get in Angola and they want to build a facility out in Angola because it's cheaper to get rubber for the shoes out there. I don't know, but it's a debt for the company.
Oh, I see. I never realized that. So if I'm a company and I'm like, man, I really could use $100 million right now to do this over here. Here, everybody, buy some stock, and you issue stock to the public. They buy it. You take the money, put it in your pocket, and go buy something. Oh, okay. I see.
Dar, do you want to add to that?
I never realized that.
No, that's it. That hit it on the head, man. I was talking to the boys back here.
Okay. What'd you share with them?
Actually, I said the same thing, Cobb. I said the same thing, but I said it before Cobb said it.
Okay.
I didn't hear you at all.
All right. And then when we talk about cheat codes, you ain't gotta look at none of that stuff you don't want to, because all your answers are right here.
Yep.
All your answers
You want
are
to
right
make sure. So you want that to be positive.
We want it to be positive. Like, at the end of the
never
day, we want it to be positive. We want to know they're bringing in more money than they losing, than they putting out, right? So
Cash is always king. Yep.
Huh?
Well, I was saying cash is always king.
Cash is king. We want
even if that number fluctuates, it's still positive.
It's positive.
There you go.
Positive. We got $1.6 billion they brought in after everything was said and done.
Mm-hmm.
They holding 1.6 billion.
Yep. Well, that real quick. That's the change in cash from the previous
year. From the previous year, yeah, change in cash for the previous year. So they lost a little bit, then they bounced back again, right? So we're seeing some trends there, right? Nothing so far. I haven't seen anything really negative as it relates to Nike. We'll pause for a second. Dante, what questions do you have?
I'm just going. I'm taking notes.
All right. What have you picked up so far?
So far, just picked up. Instead of just going by what's presently going on in the market and just going by the stock dropping in price and jumping in and buying, just to go back and check the trends of what the company's been doing over. We're starting off with the last 5 years, going and checking. I took a lot of notes. And considering the dividends over these quick payout stocks.
Yep. Kendall, you got any questions?
Nah, I'm soaking it all in. Same as Dante. I mean, I was the one that just purchased a stock because it was lower, and I was the AMC guy. Like people want to go back to the movies eventually, thinking like that. But now look at trends. I bought 2 stocks thinking like, oh, people are gonna start flying again, American Airlines. So. But looking at trends, that really helps me. And then dividends, I didn't know about dividends before. So looking at
So some of this stuff is going to come at you guys fast because, like we said, we've been talking about it for 3 weeks now. But you're going to catch up real fast. You're going to catch up real fast. Mike, Wiggy, what you got? You got any questions?
No, I don't have any questions or whatever. I'm just like a fly on the wall listening, taking some notes. I did know a little bit about dividends, looking at that because I think it's important to figure out how can you basically accumulate that long-term money, and then if you can invest in those and you can get a couple of those going, and just trying to figure out how do you strategize and land those, I guess like annually or as far as like how they pay them out. But that's pretty much where I'm at with that.
Yeah. And Joe, we're gonna answer your question about that price, about it if you're getting in at the right price. We get in there real soon. So I haven't forgotten about that. When we get to that, that's when James is gonna get a chance to answer his question. So James, I ain't forgot about you either, just so you know. FYI. So I'm gonna take over a little bit just so we can move it a little bit faster. The other thing that I look here is I'm looking at this free cash flow. That means that's just cash, straight cash. This is money in the bank. 2.7 billion, 1.6 billion, 2.2 billion, 3.2 billion. I don't own. I got money, right? And that's what I want to look at on here because that's important to me, right? So when you go through a stock, the first 3 things you're going to do is look at this income statement, look at the balance sheet, look at the cash flow, make sure you don't see anything negative. The hard part about this particular conversation, we've been looking at relatively positive stuff. When you go to look at some of these other stocks, you're going to see some really, really bad warning signs, right? That says like, man, I shouldn't be fucking with this, right? Another thing that we want to do is we want to go to this overview. This is going to be like another major cheat code right here. It's a major cheat code. So when we see the sector that they're part of, which is a consumer discretionary, right? That's what just a store, if you will, or we selling a product. And then we're going to scroll. This stuff is important, but like if you're making your decisions based upon the 52-week range, that's what the rookies are doing. That's the mistakes that people are making because you're like, ooh, the stock is $90. It was $105. I should buy it. That's not a good reason to buy it. Okay. So we're not actually going to pay attention to a lot of this stuff. I will tell you this 50-day moving average and this 200-day moving average can be important to answering Joe's question. So as Joe's like, is Nike a good price? Is it a good price for me to buy Nike right now? And I would say Nike is currently selling, or when it closed today, sold at $98.58. Right, Joe? So when I look at this over the last 50 days, the average price for Nike was $85. Right? Over the last 200 days, the average price for Nike was $91. Right? So if it's currently $98, it's above the average over the last 50 days as well as the last 200 days. That's one initial indicator of whether or not you're paying too much for it. You see what I'm saying? Did you get that so far? So now the other parts that's important. Other parts that are important on here that we looked at is, I love this one right here. Profitability, because that's what I care about. Gross profit margin, they're bringing in 44%. So for everything they sell in general, their profit margin is 44%. If you run a business or you're selling a product, you're hoping for 30, 35% return on your investment. Yep. You're bringing in 44. That's good. Anything above 40 is really good. Anywhere from 30 on up is good. Anything below that, like something changes drastically, all of a sudden you ain't got no more business, right? Coronavirus happens, you make a 20% return on or gross profit margin. Now all of a sudden your store is closed for 2 months, you're done, right? So I like to see this profit margin above 30%, and in a real good case, above 40%. Also, return on equity. A lot of times they talk about wanting that to be above like 20%. That's kind of off the charts at 47%. But this is only so helpful because the next tab that we're going to touch is going to be a little more helpful to really understand this area. And again, gross profit, I mean, $18.52 billion. And here's what I love to see too. The total cash, check this out. $3.1 billion in cash that they're holding. They also have $6.6 billion in debt, right? So they got more debt than they got money, right? That could be a good or bad thing, and I can't really answer that question unless I see what's going on with their peers. But I will tell you this. Facebook has $60 billion in cash and $10 billion in debt. They're printing money. They're printing money. If they paid off all their debts, they'd have $50 billion in their pocket as a comparison, right? Those are just some things to look at. Now I'm gonna go over here to the peers. So again, like I said, they're not comparing themselves to Reebok. They're comparing themselves to Starbucks, Disney, Visa, right? When we're here, what I want to see is the growth, revenue growth over time. Over the year, 6.5% in revenue growth as compared to Starbucks at 4.2% or 4.3%. And then I'm looking at Disney. This is how sometimes you're like, oh, I came here to talk about Nike. Let me check out Disney. Right? Because of their revenue growth over the year. Then we're talking about revenue over 5 years, and now it starts to even out a little bit more. I'm looking over here at Visa like, man, Visa is kind of doing it over here. So maybe I want to look at Visa, right? Now we're on the profitability. Gross profit margin of 44%. But look at Visa. I told you this was great. This is stupid.
So is Visa gonna be my new T-Mobile?
I'll tell you, I've been wanting to buy Visa. Visa's a little expensive, but I mean, think about it. They're printing money. You pay your Visa every month. Who ain't go on your wallet right now and tell me you ain't got a Visa in it?
Everybody got Visa card.
Got a Visa card, right? Same thing, like return on equity. Now look, I got 47% here. Starbucks is negative 53%. I would have never assumed that, right? So when you go back to that last page that we just looked at, you want to make some comparisons, right? And then we talked about this last week, which was crazy. We talked about the net income per employee, meaning I hire somebody, how much money are they worth to me? How much are they bringing in? At Nike, for every person that's hired, they're worth $56,297. Is that 56? Is that 56 million?
6,000.
It's 56,000.
Right?
56,000, which that's decent. Starbucks, every employee is only worth like $9,700. But look at Visa. For every employee they have, they are bringing in $640,000 of revenue. Now they're paying
That's
some.
income. Oh, it's not revenue, it's income.
It's income. That's
Which
income.
is even better.
That's after everything.
Go
After
up,
everything paid
go
off.
up on the revenue. Everything.
Huh? What'd you say?
Look up one line on the revenue. 1.18 million.
That's the number of employees.
Yeah. There we go.
Employees, yeah.
Right. Revenue
Revenue
per
per employee.
$1.8 million per
Employee
employee
ranks 1.8 million.
at Visa. So somebody at Visa is doing customer service. They getting paid $40,000, but their contribution to the company is $1.18 million at Visa. So I came in here to look at Nike. I might be fucking with Visa based upon what I see, right? Don't get it wrong. Nike ain't too shabby, right? The revenue per employee, I'm getting $510,000 per employee that works at Nike. So you selling shoes in the store, this is what you make in that store. But they're not paying you that, right? And then we want to look at their 5-year performance. I kind of skip all this other stuff. I just want to know what they've done in the last 5 years. They've been doing well. But look at Visa. It's everywhere you want to be.
That's a good one.
Okay. And then we can look at the dividend, right? And see their dividend rates. We can compare that. They all pay, right? And now this is what I really want to look at too. You should be looking at this no matter what you're invested in, is their return on your investment. If you had this Nike for 10 years, you got a 518% return on your investment, which is fantastic. But look at Visa. But look at Visa.
Yeah.
Let's not forget.
Yeah, that's really good.
And let's not even forget Starbucks.
What's the correlation between Disney's? I remember you went up before, and I think it was either total revenue or something like that Disney was bringing in, and percentage-wise was really good, but their 10-year return is not as good as some of those other companies. What can be the deficit or the?
You have to go back and do everything we just did
for Disney.
In order to be able to
yeah, with Nike. Yeah,
for Nike.
1,000%. That's like 10 times your money, isn't it?
Again, we're just looking to get 8 to 12% return, right?
Right. Now that's over 10 years. But even a 3-year, even if you just did this 3 years ago, or even with Nike, if you decided not to buy something, if you decided 3 years ago, who bought some Nikes 3 years ago? If you decided 3 years ago to not buy a pair of Nikes or to buy a share of Nike, you right now you have some old shoes that you don't wear no more, or you would have had a 94% return on the money that you put in.
It's almost double your money.
You could have done that for a pair of Jordans. You could have got 3 shares of Nike, literally. Okay, and then the same thing here when we're talking about the revenue. So all this stuff that we pulled in from those other pages are all here in real clean, overview page.
Oh, if I can real quick, this page is like comps in the housing industry.
Yeah.
So you know how you put your house on the market, and then you have to have comps that are comparable to what your price is to make sure it's legit. That's all the pages, comps in the housing industry.
Yeah. So again, the operating income of $5.18 billion. But look at Visa. I really want to buy Visa, y'all, in case you didn't notice. And then even with the debt, we can see they're in comparison. When we saw that debt of 6.6, we were saying that's a lot of money, right? But Starbucks got 22. Yeah, but look at exactly. Starbucks got $2 billion in debt. Disney is $59 billion in debt. Visa's $18 billion in debt. So now Nike don't look so bad.
Nike's ratio was 2 to 1. Disney or Starbucks is 10 to 1, and Disney's like 3 to 1, and Visa's probably like 2.5 to 1. So it's about equal with Visa, right, who's producing pretty high. So yeah, 1.
So a lot of these answers are here, and then again, here's our favorite line right here: free cash flow. That's just money sitting in the bank. Do whatever you want to do with 2.9 billion. But look at Visa. It's everywhere you want to be. Okay? So now we've got, now you guys should be able to do this on your own. Right? We start off at the summary. We start looking at the 5-year first. We see a trend. If we don't see this trend going upward, we're not doing no more. We stop it. We're not doing nothing else. Right? Then we go into the key data. We're looking at the income statement. We're looking at the balance sheet. We're looking at the cash flow. We go to the overview, and that's going to give us the general information that we want to see. That's all pretty and smooth and clean. And then we want to look at these peers, right? And check that out. And so we liked Nike. Then we learned about Visa in the process, right? And so then the last thing we're going to do is we're going to go, well, there's a couple things we can do on here, but let's just go, we're going to go here to the dividends. And here's where James's question was coming in. So last week, well, you can set the stage, James. What did we do last week? And what were you tasked to find out?
So last week we were given an assignment to come with a stock that we could go through this process that we just went through with Nike. And I brought to the table JJSF, which I guess is Johnson Johnson Snack Foods. It's the organization. The only reason it came up is my daughter said something about Sour Patch Kids. Sour Patch Kids falls under the J&J Snack Foods Corp. So, and we were using it to look at the dividends. And everything looked good as we were going through the research until we got to this page where we were looking at dividend payout ratio, which is astronomically high. Based on what I was understanding, like a good rate return was like in the 40% range, somewhere around there. And when I first looked at the 175, I'm like, oh man, that's great. But it's like, with it being that high, that's a cause to press the pause, but to do a little bit more research to try to determine why the payout ratio was so high. So I did at least do some research.
Before you say that, James, just real quick. So they're actually paying out more money than they're bringing in at 175%.
Right. So the payout ratio is actually the amount of dividends that you pay out over your net income. And what I was trying to figure out was, based on how my research resulted in a lot more questions. So I was trying to figure out if this dividend payout ratio reporting is based on the current stage. Is it like for this quarter? Is it annual? And I couldn't find, I guess you can do your own calculation when you find out the amount of dividends that have been paid out and then whatever the net income is at that time. But I wasn't sure what Seeking Alpha was reporting or for what time period it was reporting. But let me see if I can get my notes real quick here. So based on what I was reading over this last week, if a company has a dividend payout ratio of over 100%, and it usually means, it obviously means that the company is paying out more money than it's actually earning or that it's bringing in. It's typically not a good recipe for the company's financial health. And it could be seen as the potential for the company to cut the dividend payment in the future. So that was something that I didn't know. I figured that was kind of at least one conclusion that could potentially be drawn from it being so high, is the potential for, because it looked like when I was doing my research that it wasn't so much that the dividend percentage was changing astronomically over time, but I was trying to find what the net income was. If the percentage was similar, in my mind, the net income must have been dropping. That's just from a numbers perspective for me. But I couldn't find details, so that's where I was coming to the point of asking questions. I'm like, I don't know what the scenario was that caused this to take place, but I want to do some more digging because that's about as far as I got at this point. But it seems like is cause enough to press the pause button, because it seems like the stock itself is still progressing positively. It's just that this whole dividend ratio thing kind of threw me for a bit.
Yeah, so we were just really confused because a payout ratio is never that high. You're never paying out that much dividends, like you're paying more money out than you're making. So we didn't really understand the answer to that question. I still don't really understand the answer to that question. But what I do know is that I got thousands and thousands and thousands and thousands and thousands of stocks to choose from. I ain't got to choose this one.
Right.
Right? I ain't got to choose this one because this concerns me. I want to know why they're paying out more money than they're making. And I don't have the answer to that, even though I'm looking for the answer. So I'm on to the next one. I can spend that $128 on Nike.
Visa.
Or I can find a way to get me some Visa.
I will say this: it did create a rabbit hole situation, because I started looking up acronyms and like going down. I'm like, what I'm reading right now has nothing to do with what I was looking for, but it was good information that I was finding out. So I guess ultimately doing the research was beneficial.
Yeah. And so, Joe, the other answer to your question, we looked at the 50-day moving average as an indicator for how much something might cost. We looked at the 200-day moving average as an indicator of something might cost. If a stock has a dividend, this is the other indicator we can use. It's the dividend yield, right? And so when we click on the dividend yield, what we see here is this graph down here, right? And essentially what this graph is showing us is when it's at its highest peak, that's the cheapest it's been in comparison. When it's at its lowest peak, it's more expensive. So let me just make this make a little bit more sense. So right here, and I bet you $1 million even before I go over, and if I don't have $1 million, that's your fault. With this big peak right here, it's probably going to be in March, and more than likely might even be on March 23rd, right? If I go here, March 22nd, right? Because that was the day, March 23rd was the day that coronavirus killed the market, right? And everything, including Nike, went down. And so if I would have seen this graph on that day, I would have known on that day, based upon what I see here, today's the day to buy me some Nike stock. Because
I wish I would have known that.
don't we all, right? But I can look at the dividend yield to tell me if now is a good price and now is a good time. Now here's what we also see. As the days went by, it started decreasing, right? Decreasing. You know why? Because a bunch of motherfuckers like, oh my God, Nike is on sale, and they bought that shit up. And that's why it dipped. Like Nike, if I saw like another company that wasn't as popular, you probably wouldn't see a V like that. But this is Nike. So if Nike's going on sale, if Facebook's going on sale, if Microsoft's going on sale, best believe people are going to jump on it. So the dividend yield is going to tell us that, right? And so over the last few months, it's been steadily decreasing, and actually decreasing to a point where if you just kind of draw a straight line from here, it's pretty low in comparison to like other times. And being low in comparison to other times is not a good thing in terms of the price. Because as we already know, the current price is above the 50-day moving average, and it's above the 200-day moving average. And so it would make sense for it to be down there, right? And so you can use this as a visual indicator, and the other indicator is just right here in bold. Here's the 4-year average of 1.13, and the dividend yield right now is 1%. So quite honestly, on average, over time, it's not that much different than the 4-year average. So you can take that information and say, it's not a great price, but over an average of 4 years, it's about what it would be, right? So you can feel comfortable with buying it, but you could also feel like, dang, I could have came up over here, right? I could have really won there. But this right here, as compared to this right here, is telling me I can buy it. I'm not, it's like going to the store. I'm going to go buy something that costs $39.99. Today is $39.99, right? So I'm buying it at cost, right? Or if there's something at the store that I want, I know it's normally $39.99, but today it's $40.50. All right, I'm gonna pay $40.50 for it because so this is just additional information. And also I'm recognizing what's important too is the sooner I get in on it, the sooner I start getting paid my dividend, right? So if I wait just because I'm waiting, right, I'm not gonna get my dividend of what's this, 24 cents? Yeah, I'm not getting my dividend of 24 cents.
Are they dividend aristocrat?
No, they're not a dividend aristocrat. But here's the thing. I'm only making 24 cents off of them. So Nike is one of those rare stocks. So we talked about last week, we talked about growth stocks where you're trying to make money off the growth of the stock. Like Facebook is not paying out dividends. So Amazon's not paying out dividends. You're only making money off of the share price going up, right? So if that same scenario happened like it did when we talked about Coke, if that scenario happened where what I paid for it versus what it was now and it went down $18, I lost $18, like with a growth stock like that, right? And so that's no good, right? Whereas AT&T, they're paying me $2.04 a year, right? I'm getting 75 or $1 with Nike, right? I'm getting a little under $1 or 96 cents with Nike, right? And I paid $98.58 so that I could get 24 cents a share. But the difference is with Nike is that with AT&T, their price is going to stay roughly about the same over time. It's going to be it's going to be between $25 and $40 forever. Same thing with Coke. It's going to be in that $40, $50, $30 range. So I'm not going to be making money off the growth of the stock. Now, Nike, I'm not getting a lot with dividends, but I'm also realizing this growth, right? So if I bought it in 2018, it cost me $62, right? If I bought it in 2018, it cost me $64 or $62, whatever, and now it's trading at 98, right? So now you're starting to say, I'm getting money on the growth of Nike, and I'm also getting a little bit of money in dividend. I'm not getting a lot, a little bit, right? So now I'm balancing out. That's when you talk about your diversified portfolio. Maybe you want stocks that's getting good dividends, right? And you're not going to experience the money making on the growth side. Maybe you want to get stocks like Amazon that are going to make money on the growth side because they're just growing exponentially, but you're not getting no money from the dividends. Or maybe you want to say, I want to fool with Nike because not only are they growing, their stock price is growing, but I'm also getting a little bit of kick in on the dividend too. Right? So if I use that information coupled with the 50-day moving average, the 200-day moving average, I can make an edge. So that's part of the next part of the game. After you've done all the research to determine if you like the company, now you got to determine when do I buy it? And at what price do I want to buy it at? Right? And that's when the next phase of the game kicks in. So there we have it.
There we have it.
There we have it. I know for a lot of brothers, so I just want to acknowledge the elephant in the room, if you will. I know for a lot of brothers that came on the call today that this was like a lot of review, right? Because we went over these things. But number one, I think it's important for more brothers to come in here and learn, right? And I also think that you'll learn more, even though we're going over this thing, you'll learn more by talking and saying and sharing with other people, right? So And so in some ways, I apologize for being like a review, if you will. But at the same time, I think it was like you learned something. I'm going to ask you what you learned in a minute, but I think you also learned something in being able to share and talk it out with people too. And so we're going to keep on doing it, man, every week. I'm going to give you a homework assignment in a minute. But I really want to give a shout out to Wiggy and Joe, Kendall, who else is new? My man Mike in the back. You know what I'm saying? I want to give a shout out to you guys, Dante. I want to give a shout out to you guys for taking the first step and learning. I'm telling you, this is a good space for us to be in. You got a lot of smart brothers in this room. I defer to Godard for a lot of things. I deferred to Nate for some things. I defer to Cogs for some things. Like, brothers know stuff, right? And we all know different stuff. We are all like, you know, semi-experts in very different things. And I want us to be able to leverage each other and use each other to be able to understand that. When I started talking about the debt snowball and all that, Joe jumped in. He was like, man, I know what you're talking about. You know what I'm saying? And so we need to not only talk about stocks, but like personal finance, as James was talking about, is wrapped into the stock game, right? Like, if your money ain't right, you ain't got money to invest. So none of this means anything to you. So part of our conversation got to be, well, how you get your money right? You know, how are you bringing in residual income? How are you bringing in extra money to make sure that your money is right? Right. So that's all part of the conversation that we're having. So like I said, I want to thank you guys for coming through. Thank the brothers who are consistent, who are here every week. I'm not going to make you post on Facebook this week. But I will give you your homework assignment in a minute. And brothers that just came in, your homework is longer. So you got a bigger homework assignment than everybody else. But I'm gonna start with you, Kendall. Share what you learned today. You know, what were you excited about, whatever the case may be. But what did you get out of today's session?
Yeah, I'm just piggyback off what I said earlier. Just everything from look at how to review stocks, the 5-year growth, and not just looking at, okay, this stock was this much this month, but this much is lower the next month. So which is what I was doing. So what I do is typically I just take everything in, and my line brother BG sent me a bunch of videos that y'all talked about last time. I'm gonna go back and review those, and I'm sure I'll have questions throughout the week. So I may shoot y'all an email or whatever, Facebook message or whatever. So
Sure.
I appreciate it. This is really good. So
man, it's beautiful to have you here, man. I'm not gonna lie to you. When I saw some new faces here, a small tear rolled down my eye, man. I was happy that y'all came through, for real.
yeah, no doubt.
Winston, what you got? What you learned?
At work.
No, literally, I am working right now. Don't mess around. I'm working on stuff that's going to air in about another 3 minutes. Researching, and some key figures that, you know, give you some kind of a heads up or notice on whether or not, you know, a company is viable or worth your time in looking. I think, like you said, a lot of people would look at that 52-week average and just say, oh, well, it's $2. Let me go ahead and invest. Well, then 2 weeks from now, that $2 all of a sudden becomes 36 cents because the company wasn't worth it in the first place. So I think those kind of things definitely help everybody out, especially me.
Mike, what'd you learn today, Mike?
Wiggy?
No. Big Mike in the back with Godard.
Oh, I learned that it's like you got to go through a checklist, so it's a process to everything to find out which stock you want to invest in. And I learned that I never knew about the debt snowball effect, and that was something I learned too that could help me with my student loans in the future.
What's up?
Yep. Oh, you on mute? Oh, you hit the button.
Mute.
You.
I had hyenas running in the background, so I didn't want y'all to hear. All right, Wiggy, what you learn today?
For it being my first time, I would just say, just in general, going in for research. Pay attention to the bowl. I know the type of person I am. I am going to eventually go digging and finding out more things in detail. But I think just initially to the things that are, of course, everybody's mentioned the 5-year span mark, kind of starting there to basically look at the overall growth of whatever company that you may be interested in as far as what you're going to do research in. I wrote a couple things down because I really been just on my own saying that I really want to learn more about stocks. And I wrote down things from something simple as things that you see in parentheses. You know, that's basically a negative sign. And that's, you know, reference to debt, as well as just understanding, you know, your income, your balance, cash flow. I understand the difference between, you know, liability and assets and all of that type of stuff. And last, I would say, just looking at what we were going through today, just researching on companies like Visa, Nike, Disney, Starbucks, just to read up more about them. And the best thing you can do is, like you said, talk, get involved, and the only way you really gonna learn is to like jump in and experiment. And, you know, you'll get better with it over time.
Yep. Yep. Hey, baby, just turn it off and turn it back on. That's all I can say. You gotta turn it all the way off and turn it on and reboot. Yeah, baby, turn it all the way off. Joe.
Yeah, I kind of learned a lot on this because I never really knew the difference between dividends and things like that. I heard I have a financial advisor who would talk about things like this because I would just give him money and say invest for retirement, and you know, things would go down, things would go up. I had no clue on what he was saying. I was just like, all right, you know, is this a good thing or not? And he'll shake his head yes or no, and we go forward. So like taking all of this into consideration, I can actually have a pseudo decent conversation with him to actually understand what he's saying. Even if I don't quite understand, I can at least know the words that he's saying to start asking other pointed questions.
Yeah. I think the real goal here, and I'm sorry to interrupt you, Joe, the real goal here is that you become your own financial advisor.
Yeah.
Right? That's what we're going to shoot for.
He's the one that put me on the Ramsey joint anyway. You know what I mean? That's how I started paying off most of my debt. And I'm, you know, I do have still significant, but it's primarily tied up in my house. So everything else is pretty much close to paid off. So
we're not counting the house. The house.
I know.
House is out.
So like,
and that's
knocking stuff out.
An asset.
Yeah.
Ability. It's an asset.
So looking at it from that perspective, you know, looking at just how to go about learning how, you know, what's good, what's not, and stuff like that. So just in general, this was really helpful, and I'm going to start utilizing this most likely in the next couple of days when I can have some downtime. I have to work over the weekend, so I'll take a look at it on Tuesday, Wednesday, or something like that.
I think you a lot of times you end up in this situation where you end up getting really invigorated. I remember last time I was talking to Brad. Brad was hitting me up on Facebook like, man, I couldn't sleep last night, baby. Like getting excited. That's what we want people to be able to do. I guess the OGs in the room, I guess I could say, you guys have anything that you want to share that might have been an epiphany you might have had today or something today? Or
Visa, baby. I'm looking at Visa now. I'm on it.
It's everywhere you want.
I'm on it.
Me too.
That's all I'm gonna say. Visa.
Brad signed up now. He free good.
You gonna leave T-Mobile like that, man?
I'm gonna leave T-Mobile.
He got a new girlfriend.
Because I moved last week. I moved from T-Mobile to AT&T. So this week I'm gonna see what Visa, Discover, and all them boys doing. See what it was going on over there. See what they do.
It is expensive,
I
though.
enjoyed it once again, though. I enjoyed it.
And for me, the learning that I had actually came a couple of days ago when I ended up on that Guru Focus page. What that AT&T dividend thing just tripped me out. Like, I couldn't put together how you can lose $15 on a stock and still have a 30% gain. Like I couldn't. That blew my mind.
I got one quick question, really quick. I see seekingalpha.com is one of the main places y'all go, and Google and things like that. Do you have a list of like websites that you tend to go to often, that you kind of consistently rotate through to get information?
Yeah, so for me, I go to Seeking Alpha because like visually it just works for me and the flow works for me. A lot of people use Yahoo Finance. It has the same information, but it just doesn't. It's like what Jason was saying earlier. Certain voices don't click with you, so you go and use something else. So a lot of pages, they all have the same information. They're only going to give you 5 years. I don't know, somebody got a party going on now. But they're only going to give you 5 years. They're not going to give you like the whole spiel for the last 20 years or anything like that. They're all going to give you a balance sheet. They're all going to give you an income statement. They're all going to give you the cash flow. I just like how Seeking Alpha is laid out better than anybody else. But, maybe you're MSN folk person, or maybe you're a Yahoo Finance person or whatever. But to me, that's what I use. I know Godard and probably Cogs, they use Thinkorswim to do a lot of their stuff. But Thinkorswim is, a completely different platform and a whole different beast. But different people use different things. But the underutilized thing that I haven't used as much, and I actually want to get into practice of doing more, is going straight to the source. Skip the middleman and go straight to the investor relations page, right? If I'm interested in a company, maybe after I look at that 5-year joint, like I'm going straight to the page. I'm going straight to Nike's page, and I want to know everything you got to tell me. And there you're going to see the videos to watch their CEOs and to see how they're responding to things when they're doing their quarterly reports or what have you. Huh? Yeah. So I can get it straight from the horse's mouth, right? So I actually want to challenge myself, and maybe that'll be my own homework. I want to challenge myself to like really dig into. Matter of fact, that's gonna be everybody's homework. So I got my homework assignment already. So yeah, there's gonna be different sources. But before I give you guys your homework, and then we can rotate to whatever's next. Any other things that anybody wanted to share? Anything that they learned? Lil Rob, we're looking at you.
The
Sitting there
dividend
pretending like you an OG.
aristocrats, and just how like if you reinvest the money that you make from a dividend, how you can compound your earnings over time rather than just cashing it.
There you go. There you go. All right, so homework assignment. Homework assignment for new people. You got multiple homework assignments. Your first homework assignment is you got to go on Facebook on the page and share whatever your experiences were, whatever you liked, the things you just said.
On what page?
On the Facebook page, on the EPI Facebook page. Right. So I'll post something in there after we get off, and just comment under that about your experience today. And it's basically, we know how EPI works. EPI is a fear of missing out organization. So Kath won't come if you tell them, hey man, I got gold, come here. Like, yeah, whatever. Until you say like, man, there was like 30 of us in there, then all of a sudden it'll be popular. So we're trying to get it to where I want us to have more brothers in here, especially some younger ones in here, to be like soaking this all up, right? So your assignment, number one, is to go on the EPI Facebook page and post. That's number one. Your second assignment that you also have to do, nobody else, is you got to bring somebody new next week. You got to bring somebody new next week. Line brother, big brother, younger brother, whoever it is, you got to bring something new, somebody new next week. to the table. And then the third assignment that you got to do that's connected to that new person is you got to explain to them what you learned today. So it's your job to kind of catch them up. You're like, hey man, I don't know everything, but let me show you this. Let me show you Seeking Alpha. Let me show you what we kind of looked at. You got to give them a basic foundational conversation. You ain't got to know everything. You ain't got to tell them everything, but give them a starting point. So, Kendall, repeat all the homework assignments you got, because you got more.
Yeah.
You got
so,
first.
Share the experience on the E5 Facebook page. Bring someone new next week, and then explain to them what I learned today.
There you go. There you go. And that's for you guys to do. The homework assignment for everybody is find a stock. Find a stock. I'm a cold call somebody next week, so don't come in here talking about you didn't do your homework. Find a stock, and I actually want you to go to the investor relations page. We're not doing Seeking Alpha next week. We're gonna go. Well, we might do a real quick, brief, like overview to see what it looks like. But you're gonna walk us through the investor relations page and tell us what you learned on that investor relations page. So do your little research on your stocks or whatever, like with Seeking Alpha. Once you find one that everything you saw looks good, your job is then to go to their investor relations page and dig in it and know how to navigate it. So when we come on next week, I might call you. I'm like, hey, Joe, I'm not going to get to everybody, obviously, but you need to be ready. Say, hey, Joe, show us the investor relations page that you found. And if he's like, all right, I looked at Starbucks, and here's everything that Starbucks got going on. Here's what they're looking at doing in the future. Like, we want the full deep dive. So, and I'm going to do it myself. And so my job is to look at the investor relations page of something I'm interested in. I'll explain to you all what I see on there. But ultimately, I want you guys to do all that so we can do a deeper dive on it. So that's your homework assignment. The only other one is I'm not going to post the video, but actually, I will post the video. I'm going to post a video on Facebook of last week's Market Monday that Earn Your Leisure did. Some of you guys referenced that earlier. I think it's a really good show, especially for relatively new investors. So watch that. It's an hour and a half long, but it's really entertaining. You can just press play and just listen. Because there's two different cats on there this past week. Wall Street Trapper was on there, and Ian, the master investor, was on there.
It's called Earn Your Leisure.
I'm gonna post it, so you don't have to worry about it. I'm gonna post it on the Facebook page, so you can see it. But check out that video, and just learn some more. But I guess I'm going to end by saying this, and it's related to Joe's point, but it's also related to this homework assignment. These cats are giving out game, they're giving out information, but they're also selling the business and selling the product. I want to get to the point where none of y'all have to ever pay anybody to do any investing for you. You know what I mean? Like, we have enough capital, we have enough knowledge, we have enough information here. And, unfortunately, a lot of cats, when they get into investing, they're just trying to come up. Like, man, it's people chasing viruses and like, who's going to come out with the coronavirus? I'm going to invest in them. Like, you don't know that. You know what I'm saying? Like, we want to do investing, and investing is long-term. You know what I'm saying? So we're looking at long-term companies, viable companies that we know, companies that we've done the research on. And man, you don't need nobody to do that for you. You can do that yourself, right? You don't need nobody to do it for you. And I bet I got a little small another assignment for you, some of you new cats. Go look up ETFs too. We didn't talk about that. We talked about that 2 weeks ago. Just as a general, I'll go over it again at some point. But look up ETFs too, because if you understand ETFs and you understand this fundamental analysis that we're doing, you don't need nobody at all. You can do it yourself. You don't have to pay nobody at all. Okay? So, man, that's it for today. Again, glad all y'all came.
I got one last thing real quick.
Yeah.
Join this line Sunday night, 7 o'clock. It's going down. Nate Dogg, EWF, Big Brother Verbos, the Ivy Brothers. It's going down. Trust me, you ain't going to miss it.
So they're having a battle with Earth, Wind, and Fire versus the Isley Brothers. There was a heated debate about what was the better group. So that's happening.
Nate's having a battle.
Dom said that's not a battle, but
yeah,
it's happening.
You're right. I'm about to win. You're right, Dom. You're right. I'm winning. You're right. Thanks.
He's ain't a battle.
And I ain't got no questions either.
Yeah.
That's like calling like Mike Tyson and Spinks, Michael Spinks, a fight.
There you go. I'll bust it up if you want. I can bust it up with you, no problem. I'm gonna knock you on the 10th round. I'll bust it up with you.
I'm gonna keep this open. If everyone talk a little bit, I gotta go do something real quick, but I'm gonna keep it open. But everybody got their homework assignment. Make sure you do it. And let's keep this momentum going, man. I really like when I said I was gonna do this 3 weeks ago, a month ago. I thought it was just gonna be a one-time shot and we were gonna be done. But I don't think that's the case now. And I wouldn't be surprised if one day we have a real, EPI investment club and we start doing some stuff together. That's aspirational. And I can't wait for the day when we start to get, I can turn the keys over and give it to Godard and Cox so they can start talking about some technical analysis. We're far away from doing that yet. But I can't wait till that day comes so that we can really start teaching ourselves and making money, man, because it's not that hard. It really isn't.